right, so what we're going to talk about today is S corporations. That's study unit 10. So S corporations, if you have a different edition, it might be study unit 16, but for the edition that we're using this semester, it's study unit 10, S corporations. And also we're going to talk about study unit 11, partnerships. What's a S corporation? Who could tell us what that's about?
Well, according to your videos.
Yeah? Some of you actually watch them.
Yes.
You know how I know?
All 17.
You want to know how I know?
How?
You know how I can tell? Because I just look at your exam score and I see, yes, this person watched the videos that I made available in November. And you're like, wait, no, the class didn't start until January 28th. I know! I know!
When you were
That's my point.
When you were emailing us that time, we were busy studying for our marketing exam.
Oh, yeah?
In November, December.
Oh.
But yes, but no, I actually started watching it after you did the last video.
Yeah.
For that exam, because I was kind of scared, because you didn't really cover it.
Oh, I thought you were going to say you were kind of bored or something.
No,
or you were snowbound.
your videos were the highlights. I actually learned a
No
lot
life.
just looking.
Did it? No life.
Just looking at them.
Really?
Never mind, my other class suffered a little bit, but I enjoyed looking at those videos. But according to the videos, you said the difference between the S corporation and the C corp was that the S corporation isn't really double tax.
Right. Absolutely. So there's advantages from being incorporated. Now, you might have, thought that there's only one type of corporation, but actually that's not the case. So there's a distinction between what Erlene is saying, a C corp and an S corp. Now, what are the advantages of a C corp? Why do people incorporate?
Limited liability.
Limited liability? So who wants to elaborate on that? What does that mean, limited liability?
You are responsible only as the assets that you invest into the corporation and not as the assets that you personally own.
Right, so Maria is saying that your liability ends with your investment in the company, the assets that you have invested in the company. So the shares that you own in the company. So if you have $50,000 invested in the company, so you have $50,000 worth of shares, Maria is saying if for some reason things don't work out, the company goes bankrupt, then the most that you would lose is your $50,000 investment. They can't come and take your house. It doesn't matter if you have 3 homes. They can't take your Bentley. They can't take your Maserati. Did anybody go to the auto show? You did?
No, that wasn't me.
You went? Yeah, it was really something. I know which car I'm getting. So that's a very important distinction because otherwise you might just be operating as a sole proprietorship. So there's different entities. An organization can operate as different entities. It's up to us to decide, right, as executives, as senior executives, it's up to us to decide what entity the organization is going to adopt. It's referred to as entity choice. Entity choice. What is this? Entity choice. It's actually what we're going to talk about, and the way we're going to discuss it today. I'm trying to make it so that it's digestible so that it's something that you could grab hold of. But this could be a very complicated decision. So today we're going to talk about, well, you could either be a sole proprietorship, you could be a C Corp, you could be an S Corp, you could be a partnership. Now, consulting firms get paid a lot of money to make decisions like this, to make recommendations to firms regarding the type of entity that they should be. Because for one, there's liability implications. So being a corporation sounds very appealing. It's not expensive to become a corporation. So how do you become a corporation? You file with who?
The state.
SEC.
No, not the SEC. Yes, go ahead, Erling.
You file with the state.
Right, you file with the Department of State.
Oh,
It's very. There's a lot of other. There's a lot of other things you gotta file with the SEC. But when you're just forming a corporation, you don't need to file with the SEC. In order to incorporate, what you need to do is file with the Department of State. And if you want to form a corporation, I could help you with that. It's actually, it's not difficult to form a corporation. The fees are very minimal. What do you think is minimal?
200 something.
200 something? Anybody else?
450.
450?
500.
500? So, yeah, so if somebody told you that, it costs $10,000 to form a corporation, that's not correct. Then they shouldn't be, even if somebody's going to charge you for their time as a consultant, it shouldn't be that much to form a corporation, because basically it's just one page. So it's easy to form a corporation. So what does that tell us? Because when we think about the tax code, which is written by Congress, we understand that the tax code is written in a way to motivate taxpayers to behave in a certain way. What does that mean? So why do they let us itemize mortgage interest? You think they just said, let's see, we need to have 10 things that taxpayers can itemize. So they all sit around and say, oh, we gotta think of something. We need like 10 of them. So we could publish this Internal Revenue Code that's a zillion pages long. So we need like 10, right? So what are we gonna allow people to itemize? Mortgage interest. Why? Why did they come up with that?
So you can buy
They
more
encourage
houses.
you to
Buy more houses.
So to stimulate the housing market, so that to motivate people to buy homes. So to being able to deduct your mortgage interest is a significant tax advantage. The first year, well, like for probably maybe even the first 10 years, because your mortgage is amortized, so you're going to be paying basically just interest. So you're very easily, we're not even talking about paying, let's say you borrow $350,000 or $500,000 and you have a 7% mortgage. That's $35,000 a year,
Yeah.
just in interest. We haven't even talked about paying on the principal. So $35,000 a year just in mortgage interest. So Congress says, well, you can take that as an itemized deduction. Well, that's going to significantly reduce your taxable income. Now, so you say, Coach, so like, where are you going with that? Okay, so where am I going with that? So it's very inexpensive to incorporate because the government realizes that it's in the best interest for organizations to incorporate. So they want to make that accessible. And so the filing fees are really minimal, certainly, definitely less than $1,000. You could have your your application expedited, and that's another $125, and so there's definitely some fees that are associated, but it's really nominal when you think about it. Now, you have the limited liability advantage, but Erlene suggested that, now wait a minute, if we incorporate, what's this about double taxation? There's an issue with double taxation. Why? Because what happens is the company pays tax on the income that it generates, right? So the company is going to pay tax on the income that it generates, and then what's left, so $100 million, the company has $100 million in income. It pays, let's say the nominal interest rate, so what they actually end up paying, this is not their tax bracket, but let's say what they actually end up paying is 20%. So that means they paid $20 million. What's left? 80? Wow, you're really, have I told you you're the best students ever? You are really, you are the best students ever. So $80 million is left. Now what can they do with that $80 million? Two things. Just two. What can they do with that $80 million?
We create any.
You can pay dividends or reinvest.
Say what now?
Pay dividends to the shareholder or reinvest them.
Right. She really did much divisions. But you need to get a life though. Yes, you could pay dividends, or you could retain that as earnings. Right? The company can retain that as earnings. Now, of that $80 million, let's say they decide that $40 million let's say 60% of that they decide that they're going to pay in dividends. So how much is that? How much is 60% of 80 million? Oh my God.
48.
You sure?
Yeah.
48 million?
Yeah.
So they decide that of the 80 million, they're going to pay 60% in dividends, which is $48 million. But now, guess what? This is the argument as it relates to double taxation. The argument is, well, wait a minute. This was the income. We pay tax. It turns out that the nominal interest rate, remember I said it's not the tax bracket, but the nominal interest rate in our scenario is 20%. They paid 20% tax. That's what they paid in tax, the company, our company. They paid $20 million in tax out of this $100 million in income. 80 million is left. Now, of that 80 million, they decide that they're gonna distribute 48 million as dividends to the shareholders, and the other 32 million, for you super quick students, right? They're gonna keep as retained earnings. Now, the argument is, whoa, I was born at night, but not last night. Are you kidding? Wait, so now when the shareholders get those dividends, remember we talked about gross income, what's considered to be income? These folks, the shareholders, are gonna have to pay tax on this. So aren't dividends taxable income? Dividends are taxable income. But this is the same $100 million. We paid tax on that. This is what was left. Now we're just saying, I'm gonna put 32 million over here, and I'm gonna put the other 48 million over here, and I'm just gonna give it to the shareholders. I'm gonna give $48 million to the shareholders. But when the shareholders receive it, it's taxed. Right? It's taxed again. Whose $100 million is this? That's the $100 million of the shareholders. Of course, you have a management team. They manage a business. You have a president, 10 vice presidents, 15 directors, 45 managers, so on and so on. So you have a management team, but the company is owned by the shareholders. So, on behalf of the shareholders, this tax was paid. Now, when we distribute these funds as dividends, when those shareholders receive dividends, they have to pay personal income tax. That's considered to be taxable. So that's what Erlene is suggesting when she says that there's double taxation. Why? Because this is the same money. This is the same, these are the same dollars. So the money is taxed twice. So actually, Congress says, yeah, but that's life. They say, yeah, no, we got it. But yeah, you're right. But they said, this is what we're going to do. Under certain circumstances, a corporation can elect, right, can request with the Internal Revenue Service, with the IRS, to be classified as an S corporation. So, as to avoid double taxation. Now, we said that to become incorporated, you file with the Department of State. The S corporation
with the IRS.
is filed with the IRS. So that's definitely a tax issue. Even though the scope of our course is beyond taxation, it's taxation which is part of regulation, okay? But nonetheless, this is definitely a taxation issue. S corporation. You can't ask the Department of State to classify you as an S corp. That's a tax issue. The IRS is empowered to classify a corporation as an S corp. And if that's the case, what's the criteria for S corps?
100 or less shareholders.
Yeah, so if the corporation has 100 or less shareholders, right? This is one of the main criteria. There's several, but one of the main criteria is that the corporation has 100 or less shareholders. You think 100 is a lot?
Somehow it doesn't make sense that there's a number of shareholders and how much do they owe?
Oh, we're gonna get to that. But first, do you think 100 is a lot?
No.
Because there's companies that have literally millions of shareholders, right? So 100, so Congress says, but we realize that a lot of organizations incorporate because of the limited liability and other benefits, and we think that's a good thing, that they should incorporate. So we realize though that there's double taxation, and we don't want to stifle the growth of small businesses. Because if it's 100 or less shareholders, it'll be considered to be a small business. If that's your key metric, is the number of shareholders. It might only be 2 shareholders. It might only be 3. It might just be me and the rest of us. We're all shareholders in a company. Of course, I'm the majority shareholder, but you guys will each have some. You guys will each have some shares in the company. Now, so show up, this guy, I don't know why. I won't have a voice by the end of this night. So now Marie says, wait a minute. So, but they still have to pay tax, right? So how do they determine how much tax is paid? So what the company does, right? So you're still a corporation. What the corporation does is they file a K-1 form. What is the K-1 form? The K-1 form lists the shareholders. Erling says 100 or less. Used to be 75. The number keeps changing. The K-1 form that's filed with the IRS lists all the shareholders and how much they received in dividends. Now it might be that all the shareholders receive, let's say, $5,000. It might be they all receive $10,000. It might be received that some receive $50,000 and all the rest receive $1,000. However, why or that might be is a different issue, but it's the responsibility of the corporation to report that information to the IRS. And then it's the taxpayer's responsibility to pay the tax. Now, can you avoid paying tax? I mean, can you, is it possible that you could successfully not report that information to the IRS and not have to pay tax? Paul?
No,
No, why?
because if the corporation is reporting directly to IRS,
Right.
regardless.
The K-1, there's no way. Just like on your mortgage interest, you say, oh, this is great, $35,000. I'm just going to say I have a mortgage. You can't just do that. First of all, it's unethical. Second of all, it's illegal. And third of all, most importantly, you're going to get caught. Why? Because the mortgage company sends a 1098, which is simply electronic transmittal that says how much mortgage interest they received from you, if you actually did have a mortgage, right? So the person who has the, who's paying on the mortgage.
That's the same thing as the 1098T forms college students receive.
Right,
The same issue.
right.
But the thing is, like, if they're getting all this information, why is it like we have to report it if they already have it?
Right, so,
Extra work.
yeah, no, you're right. They have nearly all the information.
Are they testing us?
No, yes, they are. No, they have nearly, the IRS has nearly all the information. So one of the things that has been suggested is a flat tax. Because they say that this thing, it's too complicated, unnecessarily complicated with deductions, and deductions don't favor everybody. It certainly favors some, but not all. So then the argument is that, well, some people are making a lot of money
Yeah.
and they don't pay tax at all, like even Warren Buffett said, right? Didn't he say that his secretary pays more tax than him? Now that really gives you something to think about. That's not crazy. And he said, it says in the tax code, I'm not required. I have investments in green energy. Okay, you got $10 billion tied up in green energy, doesn't pay tax. I mean, all right, so that's the way, let's say the Internal Revenue Code is written. So remember, it's written to encourage certain behavior.
So are they thinking about the flat tax?
In some countries, there is a flat tax.
Okay.
It's,
I don't feel for her because I mean, look at the income disparity between people. The rich and the poor. Why should everybody be paying the same flat tax? Because that's gonna go towards the development of communities and stuff. So.
With the money they can get away.
No, yeah, I know. That's what I'm saying. I don't favor it for the rich. For the middle class and less, yes. The rich, no.
So let's say right now, so you know you're familiar with what the tax rates are now. Let's say, for example, the flat tax was 10%. Right, so from what we know about the graduated tax rates now, 10% is much less than what anybody is paying, even the lowest tax bracket, right? So the reason why many feel that that's appealing is because, you know what they say, people who are making $25 million, they're not paying 10%. They're not paying anything because they have investments and income from sources that are considered not taxable. And I say they're not paying anything. Okay, so it's a little bit of an exaggeration, but you get the idea where it's like, well, wait a minute. But if you make $250,000 and literally walk away with 40% of your paycheck, and people who are making $40 million are paying what? 1% of their annual income? So
It could work in that case.
yeah, I mean that's the argument. And then this thing about the deductions. Why? Like you said, they have everything. Why do we need to go through all of that? You know? Do you think it's other countries? There's other countries that have adopted a flat tax. They said they're like, we're not going to get it. You're going to have to provide invoices from Kings County and pay checks and all of this stuff. And I mean, really? Seriously? All right. How are we doing our time? All right. So there's something we definitely really need to move through now. Oh, we got 3 more hours. Okay, so we're good. All right, so pay attention. Here we go. If you can memorize what I say as I say it, that's excellent. If not, take really good notes. All right, you ready? You sure? I don't know if my voice is going to last, but all right, let's try before my voice goes. All right, here we go. So, this is about an S Corp. This S corporation okay, hold on. Okay, here we go. So listen carefully. So what this question has to do with is an accrual basis, right? An accrual basis calendar year S Corp. All right, so from the beginning, this company has been an S corporation. So they've been an S corporation from the beginning. At the beginning of the current year, Randy owned 50% of the 100 issued shares of Basel stock, and had a $3,000 tax basis in Basel stock. What does that mean? $3,000 tax basis. What does that mean? What's the tax basis? Yes, the cost. The cost. What? There's 100 shares. Randy owes 50%. She bought them for $3,000. How are we doing now? We good? You got it? Fatima? All right. So the company had $200,000 in business income. So in the current year, the company had $200,000 in business income. And $4,000 in Kings County municipal bond interest. So they have income from their business operations. They also have bonds that they own that generated interest income of $4,000. What is Randy's tax basis at year end? Somebody? Anybody? All right, so the company didn't distribute any dividends. So what's the tax basis for Randy? Well, we said Randy is a 50% owner. So the tax basis, okay, so business income of $200,000. So Randy's share is $100,000. Then the company had income from municipal bonds of $4,000. Since Randy owns 50% of the shares, she has 50% of the income, unless agreed upon otherwise. So that's $2,000. Then we have to add the beginning cash base, the beginning basis, which originally was, I told you that she had bought the shares, the 50 shares for $3,000. So Randy's tax basis at the end of the year is the $50,000, which is what? $100,000. Oh, you guys are paying attention. Okay. So is the $100,000, which is half of the income, $200,000, half of the interest from the bonds, $2,000, plus her original investment, $3,000. How much is that? $105,000. So what is Randy's tax basis at year end? $105,000. Is there anybody here who doesn't think that that's going to be a question on the exam? Somebody? What do you think? No? All right. What about this? Let's see. Carolina Corporation is an S corp. They currently have, okay, 60,000 shares of voting common stock and 40,000 shares of non-voting common stock that have been issued and are outstanding. So they have 60,000. So you know that common stock, you could have common stock, you could have preferred stock. Common stock could be voting or not voting. So they have 60,000 shares that are voting, 40,000 shares that are not voting. Okay, so Carolina Corp filed a revocation statement with the consent of the shareholders, holding 30,000 shares of its voting common stock and 5,000 shares of its non-voting common stock.
Can you repeat that?
30,000, so they filed a revocation statement. What is a revocation statement? The revocation statement has to do with them revoking their S Corp status.
statements.
Why are you asking her for? She don't know.
Yeah.
Alright, so what we're talking about is,
After revocation.
what we're talking about is, we're talking about S corps, right? We're talking about, now we're focusing on the possibility that the organization, that the corporation can revoke its S corp status.
Okay.
All right, now, in order to be able to revoke the S corp election, you need the consent of shareholders holding more than 50% of the outstanding shares.
So in order to revoke it, you need what? Sorry?
More than 50%. Now, so this is the thing. On February 23rd, they filed this revocation, right? To revoke their S corp election. February 23rd. Now, it's with the consent, okay? So what we gotta decide is whether or not this is 50%. 30,000 shares of its voting and 5,000 shares of its non-voting common stock. So, how many shares do they have in total? Let's start there. Who?
100.
What? 100. Watch this, man. Watch me. Watch me. Watch me. Watch me. So they have 100,000 shares. So what I just told you is that more than 50% of
Shares are required.
the shares outstanding are required in order for the revocation to be effective. So 50% of the outstanding shares. So is 35,000 50%?
No.
So those shareholders that consented now remember, we're just talking about the number of shares. Remember, I hope you're not thinking, well, wait, I don't get it. What do you mean, 60,000? I thought you said only 100. Yes. 100 is the number of shareholders, not the number of shares. Did that throw you guys off? So they have 100,000 shares. That's fine. Why didn't it tell you how many shareholders they had? But what I'm telling you is that the shareholders that consented to revoke the S corp election only control 35,000 shares. I didn't tell you if that's 2 people, it could be 20 people, it might be 50 people that control those 35,000 shares. But regardless, they need, in order for the election to revoke the S corp status, in order for it to be valid, it needs to be 50% of the outstanding shares. We said there's 60,000 that are voting, 40,000 that are non-voting. You all agreed that's 100,000. Right, Thomas? 100,000. We need to have the consent of the shareholders that are going to represent, that control at least 50,000 shares. Right now, those that gave their consent only control 35,000 shares. So the question is, did their S corp revocation statement go into effect? Did Carolina Corporation's S corp election terminate or not terminate?
Not
Yeah, it did not terminate. It didn't terminate on February 24th. Didn't terminate on January 1st. It didn't terminate on December 31st. right, so let's talk about all right, so make a note of this. For tax years after 1986, an S corporation is required to use a calendar year unless it establishes a business purpose for using another year and the IRS consents.
Rewind, please.
Okay, so generally, a corporation can select a calendar year or a fiscal year for its business. Now, calendar year just means that their operations start January 1 and their year ends December 31st. A company could select a fiscal year, which could suggest that it starts on July 1 and ends, right, the following June. Okay, so now that being said, as it relates to S Corps, an S Corp is required to use a calendar year. This actually went into effect after 1986. But the key takeaway is that S Corps are required to use a calendar year. There are exceptions, but the key point is that they're required to use a calendar year. It's too easy, right? You're like, no, wait, what's the catch? That's it. All right, now you ready? Here we go. Which of the following, oh, we should do this on Poll Everywhere. No, that's so fun. Which of the following will render a corporation ineligible for S corporation status? One of the shareholders is a bankruptcy estate. No, that won't matter in terms of, that won't impact the eligibility for S corporation status. The corporation has both voting and non-voting common stock issued and outstanding. That won't impact the eligibility for a corporation. One of the shareholders is a decedent's estate. That's not going to affect the eligibility of the corporation. The corporation has 103 shareholders.
Yes.
Yes.
Yep, that's a
Yeah.
that one. That's a problem. That's a problem. It used to be 75. It's changed a number of times. Ooh, this is interesting. All right, what about the termination of an S corp? What will cause the termination of a corporation's S corp election? Here we go. Donation of stock to a tax-exempt organization. Okay, that shouldn't have any impact on their S corp status. Failing the passive income test for 3 consecutive years. Passive income? No, that shouldn't have any impact on their S corp status. What about you guys writing this down? Anybody trying to memorize it? Brandy. All right. Anybody brought me a hot tea with lemon, ginger, and honey and white rum? No. Okay. Did I tell you your success is my number one priority? Yeah, you believe me? Nuts. I'm hoping everybody gets 100 on this exam. I really do. Turn to your neighbor and say, you can do it!
You can do it.
You can do it! Yes, you can! Go ahead. Yes, you can! 100. All right. Write this down. Here we go.
So what will cause the termination of the escort?
Right. So, all of the following will cause the termination of an S corp, except sale of stock to a resident alien.
Wait, did we finish the last question?
Yeah.
I think it's 3, right?
I only
That's,
have
we're on the stage. We didn't. No, we didn't. We're finishing it now.
The donation part and failing in the next step.
Okay.
Sale of stock to resident alien.
What was that?
To a resident?
Resident.
Yeah, to a resident alien.
Elaborate.
So if the S corp sells stock to a resident alien, it won't result in the termination of the company.
What is accept?
What happens if the S corp status is terminated? Does the company go out of business? What happens? Yes, go ahead, Marie, say it.
It will be a sequel.
Yeah, it'll become a C corp. So if you lose your S corp status because you have a transaction that results in let's say over 100 shareholders. So if you have 95 shareholders and then at some point in the future you have 195 shareholders, then your S corp status has been terminated. But don't panic, they didn't close down your business, right? It's just that your status has changed. Your tax status has changed. You're still a corporation. You're still filed with the Department of State, but your status with the IRS has changed. And Marie said, yeah, you're not a S corp anymore, but you're still a C corp, right? What was that?
Why does it not matter? I don't understand why does IRS emphasizes on the number of the shareholders and not the worth of the company.
Oh, there's others, and we're just focusing on that for right now, but there's other criteria for S corp status, right? But that's one of the more obvious ones, and the easiest to measure. But and also it helps to give us a sense of perspective and scope when you think about the number of shareholders. But there's several criteria. That's usually the biggest issue, is the number of shareholders. All right, let's go. We're here till midnight. Let me see what time is it.
What's the answer to that? Oh,
What happened?
What's the answer to that question?
We have finished.
What was which one?
Termination.
So the donation question.
Determination.
What
of
is
the
terminating? Yes.
So, the sale of stock to a resident alien will not terminate the S corp status.
So
What was that?
Then well.
So it will.
Right.
Remember I said that, for example, if you have 90, I'm not even on corp medicine, and I have some reasonable idea about what's going on here. And you guys, didn't I just say, if you have 95 shareholders, and then at some point in the future, you have 195 shareholders, that your S Corp status is gonna terminate, right? Didn't I say that?
Is that
It's
the last
how the
choice?
question was put forth. For instance, I have to rewrite the question to say all of the following will cause termination of S corp status except. So you have to re.
Oh, okay.
I
Oh,
have the
okay.
question, what will cause the termination of an S corp?
That's what I have.
Except.
Yeah.
All of the following.
Oh,
will
really? You
cause
guys got that down?
except.
Oh, I didn't think you would notice. I just keep going.
He kind of rephrased it a bit.
Yeah, rephrase it a little bit.
Yeah.
All right, so if the sale of stock to a resident alien does not result in termination of your S corp status, then what will?
Wait a minute.
He's another question though, which is.
So the question we just did was all of the following will cause the termination of an S corp except.
Yep.
And the answer was the sale of stock?
To a resident alien.
Alien, yeah.
Yes.
Right,
Yeah.
okay.
Oh,
Have I told you you are the best students ever? I lied. Okay, so, no, you are. You are. So you got it?
Yes.
so the next
So the except sale of stock to resident alien. But a transaction that results in the corporation having more than 100 shareholders is going to result in the termination of the S Corp election. All right, here we go. Let's say that you own 100% of this S corporation. And the company has an operating loss of $11,000. And tax-exempt income of $10,000. So this information is about the S Corp. You own 100%. The K-1 is going to have to be filed. The corporation has an operating loss of $11,000. It has
Cost.
tax-exempt income of $10,000. Your basis in the business is $2,000. What is the basis at the end of the year?
basis is what? 100? 2000.
At the beginning of the year, it's 2,000.
The operating cost is 11,000. Tax expense is 10,000. The basis is 2,000 and 7,000. What is basis at the end of the year?
What would increase the basis? What are some things that would increase the basis? So your basis, remember the other example? One of the things that would increase your basis is income. Remember the other scenario? So that income will increase your basis, including tax-exempt income that's passed through to the shareholder. A loan to the corporation is going to increase your basis. So income increases your basis. A loan to the corporation is gonna increase your basis. The amount of loss that's allocated to you. Because let's say the company, so in this case, we said the company lost how much? 11,000. Well, in this case, 100% is going to be allocated to you, but if there was 11 shareholders, then that might be each is allocated $1,000. But certainly a loss is going to reduce your basis. So the question is, based on this scenario, what is the basis going to be at the end of the year?
$1,000.
Who said that, $1,000? Really? Why?
Because you started 2,000, then you have the income of 10, so it gives you 12. And then you subtract the 11.
She's mad smart. She's taking too many classes. I think she's trying to really actually catch on. Wow. Good job, Noelle.
Thank you.
All right. So, did you guys follow what Noelle said? So Noelle said, okay, we need to figure out our cost basis. So our basis, we said at the beginning of the year, was 2,000. Everybody got that? Mm-hmm. Then, we said that there's tax exempt interest. Okay? Income, income, which is how much?
10,000.
10,000. We said that's going to increase our basis. So now, our basis is 12,000. But, what happened? We said, remember I was just explaining that there's things that could increase your basis and there's things that can decrease your basis. So, what can decrease your basis? Well, we said that the company had an operating loss of 11,000. Say, okay, well, that's going to decrease our basis. We're going to take that right off there. And that's going to leave us with
1,000.
1,000. No one, Earlene, you're the only one who said no? You're not sure? Take a minute. 1,000. So, there's certain things that can increase our basis. There's certain things that can decrease our basis. So the answer is 1,000. What about if I do this? Now what? All right, tell us the rest. Isaiah, right? Mother Canova. What's your name? Melissa. Yeah. What? Melissa. Melissa Sinclair? Okay. You gonna be able to do that?
It's simple, but it's confusing.
Yeah, you gonna be able to do this?
Yes.
You sure? Want to do it 6 more times? All right, let's keep going. But so you see that, maybe the numbers might change, but
Concept stays the same.
yes. Raise your hand if you think that this is going to be one of the questions from the exam. Raise your hand. No, not everybody? Everybody not sure? But there may not be 1,000 though. It might be this. Let's see how many people put 1,000. I bet half of you will put 1,000, half of you put 16,000. It's right, Anderson?
Yeah.
So imagine you own 100% of an S corp. Up 1,000. Let's see.
Professor Rousseau, before you go on, let's say if you had the question as you own 50%, so you just slice everything in half.
Yeah. So if there was another, well, okay. So if you own 50%, right, and we're trying to figure out what would be your obligation, then, and it's 50%, then it would be half of that. Now the other 50% might be split up amongst 15 people. We don't know that. That's something that has to be agreed upon by the shareholders. All right. Let's see. So which of the following increases the accumulated adjustments account of an S corporation? The accumulated adjustments account of an S corporation. Capital contributions by shareholders? No. Charitable contributions? No. Distribution to shareholders? No. Interest and dividends? Yes. Interest and dividends increases the accumulated adjustments account of an S corp.
What was the third bullet again?
The interest and dividends. So, is this mine? Yeah. Study unit 10. You guys did study unit 10? That was 2 weeks ago you guys read that. All right, let's go. Here we go. Which of the following conditions will prevent a corporation from qualifying as an S corp?
Could you read that again, please?
Which of the following conditions will prevent a corporation from qualifying as an S corp? And the answer is a corporation that has non-resident aliens as shareholders. So if a corporation has non-resident aliens as shareholders, they're not going to be able to qualify as an S corp. So a corporation that has non-resident aliens as shareholders. So if a corporation has non-resident aliens as shareholders, they're not going to be able to qualify for S corp status.
Okay. So, I have a question.
Which of the following items must be separately stated on Form 1120S? All right? You guys know what 1120S is? So the corporate tax return, so you know the personal tax return form is 1040. The corporate tax return form is 1120. The subchapter corp is 1120S.
Each of the following items.
Must be separately stated on the K1. Gain or loss from the sale of collectibles. write this down. Which of the following events would cause an S corp to cease to qualify? So there's things, events, there's things that can happen, and there's things that a corporation can do that as a result, the corporation would no longer qualify as an S corp. So which of the following could cause an S corp to cease to qualify? The S corp transfers its stock to a corporation or partnership. That could result in the corporation no longer qualifying as an S corp.
But you said the S corp transfer in stock to a corporation. Are we stating specific? So we're implying that that's a C corp.
Right, the stock is being transferred? Yes. You know why? Because one of the requirements is that the shareholders in an S corp not be a corporation or partnership. So one of the criteria is that the shareholders not be a corporation or a partnership, but rather the shareholders only be individuals and estates and certain types of trusts, but not a corporation, not a partnership. So what does that mean when you say you transferred some of the shares to a corporation? Well, that means that that corporation now has shares in the S corp. The IRS says, no. You can't, an S corp, shareholders in an S corp need to be only individuals or estates of individuals or certain types of trusts, but not partnerships or corporations, okay? So let's see, Erlene owns 100% of S corp, and she is actively involved in its operations. The stock basis at the beginning of the year is $5,000. The corporation makes a distribution of $3,500. And passes through a loss from operations of $2,000 for the year.
Can you ever read this one, Professor?
Right, so Erlene owns 100% of an S corporation. At the beginning of the year, Erlene's basis is $5,000. During the year, the corporation makes distributions of $3,500. What is that? What when we say distributions, what does that mean? Yeah, it's like, so the company, so you're a shareholder in the company, so the company in this case is going to give Erlene $3,500. So they can distribute $3,500 to her. They can give her $3,500. The company had a loss, okay, the company passes through a loss from operations of $2,000 for the year. So, what loss can Erlene deduct on her personal tax return? Now, keep in mind that the loss is prorated, but in this case, Erlene owns 100% of the shares. But if she owned 50%, like Noel was suggesting before, if in this scenario it was 50% instead of 100%, then the amount would be 50% of these amounts. But in this case, So it's important to note that it is prorated, but in this case it's 100%. So how much can Erlene deduct on her personal tax? All right, so let's see. So at the beginning of the year, the basis is 5,000. $5,000. Now, what happened? What did I tell you?
Distribution, 3,500.
Distribution of 3,500. Is that gonna increase or decrease her basis? Which one? Nobody knows. It's gonna decrease her basis. Now, I told you that the corporation passes through a loss from operations of $2,000. How much is Erlene going to be able to deduct on her personal income tax? Somebody said nothing, and then what else? What's the other choices?
3,500.
How much?
3,500.
3,500. So far we have 0. We have 3,500. What are the other choices?
1,500.
1,500. Nobody thinks 2,000? Then I just tell you she has a pass through. So a S corp is known as a flow through entity, right? So the company itself doesn't pay taxes. Everything flows through to the shareholders. So the company passes through $2,000, a $2,000 loss. Why doesn't anybody think that she would be able to deduct that? So on the K1, it's going to say it's $2,000 and was a loss, and Erlene is the only shareholder. No, nobody thinks that? Okay, so somebody said 0. Why do you think 0?
Would you minus the 2,000 operation loss? No? And there's nothing left.
Minus the 2,000 and then what?
I mean, there's nothing left if you minus it from 1,500, so I'm thinking, okay, you can minus the 2 from 15, so nothing.
Oh, okay, I see what you're saying. So, you're close. So what Giselle is saying is that, well, if the loss is 2,000, and your cost base is only 1,500, so the question is, how much can you actually deduct? Now, keep in mind, something you forgot is that you could carry forward losses, right? So in this case, why this is relevant is because, so the $2,000, she's not going to be able to take the full $2,000 because, as Giselle pointed out, her basis is only 1,500. Her basis is only 1,500. So the most that she could deduct is the 1,500. So the answer is 1,500. How much can she deduct? Is the 1,500. But we need to do this calculation first to determine that, to figure out what her cost basis is. So we know that, now that we know that her cost basis is currently 1,500 because of that distribution, now we can determine of the loss that flowed through, the maximum that she can take is her basis. You can't deduct more than your basis.
And then 500 will carry forward.
Right, the 500 she could carry forward. All right, let's keep rolling. Here we go. Let's see. All right, here's another this addresses some of what we discussed already. A little bit of a different slant. So, which of the following will prevent a corporation from qualifying as an S corp? Having 100 shareholders? No, not that one. Owning more than 50% of the stock of a domestic corporation? Nope, not that one either. But he said, wait, you just told us that corporations can't own stock in our corporation, that we wouldn't be eligible to be an S corp. Yes, that's what I said, but I didn't say that an S corp can't own shares in another corporation. It's just that our shareholders, if we want to be an S corp, our shareholders can't be a corporation or a partnership. It doesn't mean that our S corp can't own shares in a corporation, right? Those are two different things. One of them is talking about shares that our corporation owns, and the other is shares of our corporation that are owned by others. We said no, our shares can't be owned by a corporation or partnership. But our corporation, we could have shares in corporations. That's fine. So the answer to this question is having a partnership or a corporation as a shareholder.
What was the answer?
Having a partnership or corporation as a shareholder. Okay. Let's see. For which of the following, now we're talking about entity choice here. C corporation, S corps, partnerships. For which of the following is the owner's basis increased? So for which of the following entities is the owner's basis increased by the owner's share of profits? And decreased by the owner's share of losses? What do you think? So which of the following entities is the owner's basis increased by the owner's share of profits and decreased by the owner's share of losses?
Partnerships.
Corporation, S corp, partnership.
Partnership.
Oh my God. S corp! S corp! S corp! Oh my God. S corp!
Oh my god.
So if I gave a multiple choice exam right now, what? I'm worried. If suppose I gave a true-false question, suppose I gave 25 true-false questions, how would you guys do?
Professor!
I'm worried.
Professor!
I'm worried. Yes?
Wouldn't partnership also be affected in this scenario?
No.
Trying.
S corp. All right, let's go. Here we go. What's this? Mr. Hyde and Mr. Jekyll. Whoa. All right, 50%. I just meal. All right, so the corporation had a loss of $237,800 $250. No cents. All right, divide that by 365. You ready? 237,250 divided by 365 days. So Mr. Hyde, on January 1st, 2014, Mr. Hyde purchased 50% of the shares. And on December 4th, he purchased, no, not December 1st, sorry, December 1st, 2014, he purchased the other 50%. Now, in 2014, the company had an ordinary loss of $237,250. So what we need to do is figure out the prorated loss that could flow through to Mr. Hyde on his tax return. So the way we should do that is divide the 237,250 by 365 days, and that's how much? $650 per day. So how much is 650 times 31 days? Now, how much is 50% of this? Oh boy. Yeah.
118,625.
All right, so remember, he's not, we have to calculate the prorated amount. So, which is this, 128,700. Which is, now half of this is 118,625. Anybody want to check that? Yes, that's right. 118,625. That's half. She said, whoa, half. See, Noelle, she knew. She said, but wait a minute, suppose we only own 50%. It's your fault. 50%. Why can't we just be 100%? Yep. So it's 50%. So that brings us down to 118,625. Because we're trying to figure out how much he could deduct. The loss is 237,250. All right, so that's straightforward. But then, the last month of the year, he buys the other 50%. Without that, it would just be 50% of this. You say, okay, well, how much can he deduct? He owns 50% of the company. This is the amount of the loss. He could take 50%. And it's less than his cost basis, right? Because his cost, he bought the first 50% for $150,000, and the second 50% for also $150,000. So this is definitely less than his cost basis. So there's no reason why he can't deduct the $118,625. But remember, I said on December 1st he purchased the other 50%. Now that's why we have to figure this out. So this is 650 times 31, which is the month of December, which gives us how much?
20,150. 20,150.
How much?
20,150.
20,150? And then what? We have to divide that by half, right? Ah, you forgot that. Only for 1 month, but remember for that month, he's only 50% shareholder. So that leaves us with 10,075. So 118 plus 10,075 equals this.
Can you recap that?
So
Okay.
he owned 50% of the company at the beginning of the year. So that's pretty straightforward. We're talking about another scenario like that. So it would be 50% of the loss, right? This is the loss. But then, and he bought that for $150,000, which is important to note. That's not superfluous information. That's important because remember in the other scenario, we made a note that that the cost basis was less than the amount of the loss. Well, you can't take more than what you own in the company, right? You can't deduct more than what you own in the company. But in this case, he has $150,000 tied up in the company. His prorated loss for the year is $118,000. But the last month of the year, December 1st, he decides he's going to buy the rest of the company. He's going to pay another $150,000 and acquire the other 50% of the shares. But he doesn't own the company for the entire year, right? He doesn't own that half of the company for the entire year. But he's able to prorate his loss. So what we need to figure out is that total loss per day. So if this is the total loss, $237,000. We find out that the daily loss, $650. For the month of December, 31 days. That's $21,150. But he's only entitled for the month of December to deduct 50% of that. Because remember, for that month of December, he's only owner of 50%. That's the amount that he could deduct for the month of December. Now remember, he's already taken this, which is 12 full months. His prorated share. So he couldn't take also 100%, he couldn't take 100% here. Right? So here, you're like, whoa, wait, no, he owned the company at the beginning of the year. I know, but you can't count twice the same amount. We already included that here. Now it's the last month, the last additional month. So that's the amount he could deduct. So we add the 50% for the full year, and then the amount for December, when he bought the other half of the company. All right, one more. All right, let's see, what's this? Investments.
Oh. The other 50.
Okay. You guys got this? Yeah, we're almost done. 2 more hours. All right. 50,000, all right? This is for an S Corp. They have dividend income right? This is different from dividends that they pay. This is income that they receive from shares that they own in a corporation. They have expenses that they pay for supplies. They have utilities. That they pay, that's $1,500. All right, so what is their net business income? Let's see, what do we got here? 50, 55, 57, 58.5, is that right? No? Huh?
Would you subtract these expense and utilities?
Yeah. Yeah, go ahead, tell us, Thomas. So what's the net business expense here?
51,500.
What's?
So you said business income?
So what is the amount of their net business income? What do you think?
51,500.
Somebody said 51.5? 41, how much? 41.5? Any other choices?
51,500.
So the answer is, you ready? Dun, dun, dun. So Thomas said, whoa, slow your roll, coach. Look at this, these are expenses. That's not income, right? This is 3,500. This is dividend income. These are the receipts. And so the answer is, the answer is 46,500. Why? Because the IRC specifically says that this item is counted separately, not part of business net income. So gains and section 1231 gains and losses are also not included in business net income. Net long-term capital gains and losses, charitable contributions, investment income are separate from business income. They're a separately stated item, so they're not going to be included in net business income. Does that mean that we don't pay tax on this? No, we're still going to pay tax on this, but this is a separately stated item. So it's not part of net business income. So what's going to happen is this. We're going to bring this would be like over here. You have your net business income, you have your investment income, you have your taxes paid to foreign countries, you have gains and losses from section 1231, net long-term capital gains and losses, dividends, etc., charitable contributions.